Assalamualaikum and hi everyone. Welcome to the third lecture on MFRS 140 investment property. And in this third session, we are going to focus on subsequent measurement of investment property. Under the MFRS 140, choice of accounting treatment are given. Under the MFRS 140, the first choice is cost model and the second choice would be fair value model. So under the cost model, you would notice that it is the same as cost model as per MFRS 116 PPE for the cost model. And therefore, according to the standards, after initial recognition, a property or the reporting entity shall measure all of its investment properties in accordance with MFRS 116 requirement. So under MFRS 116 requirement, the carrying amount of the investment property shall be at cost and less accumulated depreciation, less accumulated impairment loss. So therefore, the carrying amount would be at cost, less accumulated depreciation, less accumulated impairment loss, and that is the same as per MFRS 116. And as such, any fair value changes, if there is available, that would have been ignored. So no fair value changes will be incorporated under cost model. Under the fair value model, after initial recognition, an investment property shall be carried at its fair value. And it is being remeasured to the fair value at each reporting date. Every time you report or you prepare your financial statement, your investment property has to be recognized at the fair value if the fair value model is your option. Okay, so let us look at what else are there under fair value. Any gain or loss arising from a change in fair value is recognized in profit or loss. The gain or loss on the change in fair value is not the one that you will recognize in the other comprehensive income, but it will be recognized in the profit or loss to the period in which the gain arises or the loss arises. And investment properties are not being depreciated, and therefore please take note again that that is not going to be accounted for as per revaluation model under MFRS 116. So let's look at the subsequent measurement. Before that, the fair value itself is defined under MFRS 13 as the price that would be received to sell an asset, to pay or paid to transfer a liability. To sell an asset here is to the point of the owner that will sell the investment property, and in an orderly transaction between market participant at the measurement date. And fair value assume market participant, both buyer and the seller, are reasonably aware of nature and characteristic of the investment property, its current and potential use, and the market condition of that investment property at that particular reporting date. Once a model has been chosen, the company must apply that particular model, for example, fair value model, to all of its investment property, to all of it. Next is entity that chooses the fair value model will need to measure or remeasure all of its investment property at fair value, except when the fair value cannot be determined reliably. And that fact must be disclosed as well in the disclosure, why the fair value cannot be determined reliably. Voluntary change is made to the subsequent measurement, the model, only if the change result in the financial statement providing reliable and more relevant information about the effect of transaction, other events or condition to the entity's financial position, the statement of financial position, the performance which is in the statement of profit or loss, and to the cash flows. So let's look at example 1, which is going to illustrate the application of cost model and the fair value model. So you have the information of a company called Betty on 1st of July, which is the date of acquisition. So 1st of July, 05. And the company acquired a building with an estimated useful life uh, of 30 years, and that building has an undetermined future use that was actually an investment property for 3 million. So that is giving you the indicator that building is not under MFRS 116 but under MFRS 140. So EUL is the T, right? And the cost on the date of acquisition here or initial recognition is 3 million. Okay. So let's look at the fair value information that was given on 30th of June X6 and 30th of June X7. The year here is given. So we put the information. The fair value given is 4.1 million. And here, sorry, that was the other way around, 4.5 million. And here the fair value is 4.1 million. So that was the information, and let's look at what is the application if we are using cost model. What are the accounting treatment under cost model? So under cost model, bear in mind that carrying amount of the investment property would be cost minus accumulated depreciation minus accumulated impairment loss. And under cost model, there was no change in fair value that will be incorporated. So let's look at the information that we have here. So under the cost model, therefore we will ignore the information on this fair value and on this fair value, because under the cost model you will continue to provide the depreciation here as well as the depreciation here. So you will still provide depreciation under the cost model. So building will be classified as investment property under the cost model, and therefore that is the first statement that you must make, which is under classification, and then it is measured at initial cost of 3 million. That is on the date of initial recognition. Then you have to explain about the measurement of cost under cost model, which is cost less accumulated depreciation. How much is the cost? It is 3 million. And what is the accumulated depreciation in that first subsequent measurement? This is on initial measurement and initial recognition. Subsequent measurement number 1 here. The next one is also about what is the second situation, which is on the second year subsequent measurement 2. I write here. It is going to be measured at the carrying amount, and the carrying amount of course is cost minus accumulated depreciation, and here the accumulated depreciation has increased to 200,000, and the carrying amount is now reduced to 2.8 million from 2.9 million. So the fair value changes have been ignored since the cost model was adopted. Cost model was adopted, so there were no fair value changes to be incorporated. The next one. Next one is the journal entries. So the first journal entries is on initial recognition and initial measurement. Initial recognition is when you recognize, you debit and you credit the correct account, which is the asset account investment property, and the measurement is 3 million on the initial recognition date. And then the second one is the on subsequent measurement. The reporting date 30th of June it has to be provided with depreciation, and depreciation charge for the year, for the next year, also must be included in your journal entries under the cost model with the same amount, unless there are changes to the information on the cost. Next is the presentation under the cost model. Under the cost model, what you would notice is in the presentation refers to the extract of financial statement. So your depreciation would have been shown as part of your admin expenses here, your expenses. And then the depreciation for 2 years, the impact in that financial statement for 2 years. Next is the information in the extract statement of financial position, the investment property. This is the carrying amount, which is at cost minus accumulated depreciation, where the first carrying amount and the second carrying amount is shown. That was the presentation. Next is if you use fair value model. So if you use fair value model, what you need to take note is that on subsequent measurement, the changes to the fair value must be incorporated. So the cost of 3 million now will be your carrying amount in the for the first reporting date, that is 3 million, and the difference, which is again, since the fair value is more than the carrying amount, so this is gain on the change of fair value, and that is 1.5 million. This will be taken to SOPL, statement of profit or loss, as an other income. And then in the second year, the carrying amount will be 4.5 million, and you would see there is a reduction in the fair value there, and the difference is 0.4 million, and this is a loss on in the fair value, loss in the change in fair value, loss on the change in fair value. So that has to be both shown in the statement of profit or loss, must be taken to the statement of profit or loss. And the statement of financial position will report the fair value. So let's look at the application of that to our fair value model. So the building is classified as investment property that is on classification 1st of July 20x5, and the building is measured again at the same amount, 3 million, on initial measurement. And consequently, the changes in fair value must be recognized in profit or loss. Remember the figure 1.5 million and the 400,000. And the gain on fair value is charged as an income. Show the workings, which is the comparison between the fair value and the carrying amount. That was for the first reporting date, 30th of June, subsequent measurement number 1. And then the loss on fair value of 400,000 is because carrying amount is actually greater than the fair value. That was on the subsequent measurement date, 30th of June 2007. And what are the carrying amount as at those reporting date? On 30th of June, it was 4.5 million, and on 30th of June 2007, that was carried at 4.1 million, and this is at fair value, as well as this is also at fair value. Now let's look at the journal entries under the fair value model. So on initial recognition and initial measurement, we still have the same journal entry. However, on subsequent measurement, we are incorporating the changes in fair value, and this would be as part of your income, other income. So this would be your other income. And the third journal entry is on subsequent measurement 2, and that would be the loss which are being expensed off to the SOPL, and the amount is the changes in those fair value, the one that we have earlier calculated. In the presentation of the financial statement extract of statement of profit or loss, the gain is part of income, which is disclosed under other income, 1.5 million, the gain in change of fair value. The expense, to differentiate between expense and the gain, I put a bracket there. And the statement of financial position extract as at 30th June, the first year is 4.5 million, the second year is at 4.1 million, and this is at fair value. It is not at cost minus accumulated depreciation minus accumulated impairment loss. That is not the case. Here is at fair value. So let us look at transfer from investment property. According to the MFRS 140, transfer from investment property would happen if there is a change in use, transfer to or from investment property. Evidence there is when there is a commencement of owner and occupation. For example, building that was acquired for rental now is being converted into admin office. So there was a transfer from investment property to owner occupied property. So that is a different MFRS now. And then there is a commencement of development with a view to sale. Where there is a transfer from investment property to inventories. You now decided to sell your building that you have constructed, for example, in an ordinary course of business. So this will involve MFRS 102. So we just focus on the theory part for the second one. And we are going to go into the accounting treatment for the first one. And investment property is under MFRS 140. And this one is MFRS 140, and will become the building under MFRS 116. Next is the end of owner occupation. End of owner occupation meaning that at first it was an owner occupied property, and now it has changed the use of the building to become an investment property. Let's say the building that was previously used as a head office now is being leased out under operating lease to another entity. So that is a change from MFRS 116 to IP MFRS 140. This one. Next, for part C, we are going to focus on the accounting treatment, but for D, we are just going to learn just the theoretical part of it, where there is a commencement of operating lease to another entity for a transfer from inventories now become an investment property. First, you are selling your building, your houses, because it's a construction business. Now you decide to just have it being rented out or for capital appreciation. So there was a transfer from MFRS 102 inventory to MFRS 140, which is investment property. So details are provided by the paragraph 57 to 65. Disposal of investment property. So under disposal of investment property should be derecognized. This is very similar to MFRS 116 as well, where you are going to eliminate your investment property from the statement of financial position on disposal or by sale of the asset on through the and when you enter into a finance lease. Remember, if an owner enter into a finance lease, that is no longer the investment property or asset of the owner, and that would be the asset of the lessee, the investment property of the lessee. So that has somehow eliminated the asset from the statement of financial position of the lessor or the owner. Next is when it is permanently withdrawn from use and there is no future economic benefits expected from its use, no longer being used as investment property, no longer used for rental. So the gain or loss arising from the retirement or disposal of investment property, any gain or loss should be calculated similar to the way under MFRS 116, where the difference between the disposal proceed, net disposal proceed, and the carrying amount of the asset is going to be recognized in the profit or loss under other income if it's a gain or a profit, and it will be recognized as an expense in the period to which the retirement or disposal took place. So let's look at some of the disclosure requirement. This is not all of the disclosure requirement, just some of it. For details, you can refer to paragraph 74 to 79 of the MFRS 140. These are the things that should be included, whether or not the fair value or cost model has been applied, the reconciliation under fair value model, reconciliation under cost model that includes the depreciation method, useful life, accumulated depreciation, which also with the accumulated impairment loss. Remember, cost model also is the case where you have to also take up the impairment test. So make sure it is shown beginning and at the end. The criteria that you use to distinguish IP from investment from the owner occupied, the methods and assumption used to determine the fair value, whether the fair value can be determined reliably. The rental income related to the investment property, operating expenses that relates to generating the rental income among or some of the disclosure requirement, as well as some changes in fair value. That's it for the lecture. So we will focus on my next video, which is the fourth video relating to work example on transfer. So there will be another video on transfer discussing the application of the requirement under MFRS 116. With that, I thank you for watching. I'll see you when I will see you. I'll see you in my next video.